In this video, we're going to focus on three companies reporting earnings later this week. So ASML is going to report earnings Wednesday morning before the bell. Meta, Facebook, Instagram, WhatsApp, Threads, all that, they're going to report Wednesday after the bell, and Apple is going to report Thursday after the bell. So these are big, giant companies. They set the tone for early earnings, and we're going to check them out and see, are there any bargains? Are there any steal deals in these three companies? Now, what we can see is ASML over just the past month has gone up 33%. Okay, everything else is pretty much flat, or in Apple's case, it's down 6.72%. But ASML for the past month has just skyrocketed. If you look at the past 3 months, we see the same thing. ASML up 37%. Let's see, VU, the S&P 500 is up 2.6%. Apple is down and Meta is down. And it's a similar story for the past year. We see ASML almost doubling its position in the past year, whereas we see VU, the S&P 500, up about 15%. Same with Apple, and Meta is the laggard there. It is down, or it is up 4%. Now, if we scale back to the past 10 years, okay, all three of these companies are vastly outperforming the market. The market's up about 339%, and we see ASML up 1,600%. Apple up about 1,000% and Meta up 600%. However, that's the past. We are looking forward to the future, and we're going to see if any of these positions should be added to our Interflame Finance portfolio. So these three companies we're just going to look at through a growth lens. We're going to look first at Apple. Apple has a PEG ratio of 2.8. Not fantastic. Remember, we want PEG ratios to be 2 and under. Under 1 is especially attractive. So the fact that Apple's at 2.8, not too terribly exciting. We do have forward PE coming in at about 30 and 5-year forward PE coming in at 19.6. Remember, that's the PE that you're going to get in 5 years if you were to buy it today. That is if Apple can execute on about 12% growth every single year for the next 5 years. That remains to be seen. I mean, we look across the board, and these are fantastic numbers when it comes to return on equity, return on invested capital. Their profit margins are solid at 27%. But can Apple grow? All right, we see Apple that used to be the innovator, they used to be the leader in big tech. They haven't really put out anything substantial. We saw that their virtual reality goggles were a gigantic flop. They are putting out new iPhones, and everybody loves their iPhones. But can Apple be the big innovator that it always has been? So that remains to be seen when they report their numbers, when they report their earnings Thursday after the bell. We have ASML, manufacturer for big chips and semiconductors. PEG ratio, more comfortable at a 1.6. Forward PE, a little stretched at 44. However, the 5-year forward PE, if they can execute on 23% EPS growth for the next 5 years, their forward PE is going to come down to below 19. So that's fantastic and that's exciting. Return on equity, great, 53%. Return on invested capital, 50%. Profit margins, even healthier than Apple's at 29%. And finally, we have Meta. Now, Meta also coming in with a PEG at 1.6, forward PE 22.8, so not too fantastic. However, of the three, Meta has the best 5-year forward PE coming in just under 17. If they can grow 12% per year, that might be too conservative for some people. People might look at Meta and say, you know what, that company's going to grow 15, 16, 18% every single year for the next 5 years. We will see what they come out with their numbers after earnings. That again is after the closing bell on Wednesday. But we see the best profit margins of these three companies and not the best return on invested capital or equity for this company, but we do see debt to equity coming in at 0.3. Now, we do expect Meta to have an increase in their debt to equity, unfortunately, because they're increasing their CapEx spending on AI infrastructure. So we'll see what those numbers are when they update after the closing bell on Wednesday. Okay, now when it comes to growth scores, Apple's coming in dead last at a 2.5. If you're new to this channel, remember we like companies to score 5 or higher. We score companies between -10 and +10. 0 is neutral. So 2.5 is above neutral. It's slightly bullish, but we like to choose companies that are 5 or higher for real consideration for our portfolio. ASML coming in at a 6. That is above that 5 mark, and so that would be something that we would consider for our portfolios because that signals a quality company. And finally, we have Meta coming in at a 6.5, definitely above that 5 mark. And so we're going to look at the intrinsic value of all three of these companies now. Again, we're not going to look at their safety scores. These are really not safety plays. They barely have any dividends, if any at all. And so what we're going to do now is look at their intrinsic values. So on this channel, not only do we score these companies, but we want to make sure that we're buying them at steal deal at bargain prices. And so one of the best tools that you can have in your toolbox is computing the intrinsic value of a company. And I have linked in this video, in the description of this video, 4 different intrinsic value calculators that I show you how to build out in Google Sheets step by step. They are the PE ratios model, the dividend discount model, the discounted cash flow model, and the Peter Lynch valuation model based on his PEGI ratio. Now, for these 3 companies, we are only going to use the PE ratios model and the discounted cash flow model, mainly because those are the most reliable, most accurate, most widespread, well-known, and respected intrinsic value calculators that people use. These companies don't really pay significant dividends, so we're not going to look at the dividend discount model. And we have found on this channel that the Peter Lynch ratio model is a little bearish in most cases, and so we're just going to throw it out, and we're just going to look at the more reliable PE ratios and discounted cash flow models. So coming in dead last with a score of 2.5 for growth, we have Apple. Apple is currently trading at $2.55 per share. Intrinsically, we think that Apple is $2.03. That gives us a 26% premium on Apple. So this is something that right now, before earnings, we're probably going to say no thank you. We'll see what the numbers come in after earnings, but for right now, we're going to say no thank you to Apple. We would consider buying this under 173 if we wanted a little bit of safety, a little bit of cushion. And we would definitely buy heavy if Apple were to crash to 132. Okay, so for right now, as far as Interflame Finance portfolios are concerned, we're going to say no thank you to Apple. Now, same thing for ASML. They have a healthier, more respectable score of 6. However, they are trading at about a 26% premium as well. They're currently trading for 14.13. We think intrinsically they're worth 11.21. And so we would buy ASML if the price crashed down to about 9.53. If the numbers stay the same after earnings, for instance, revenue growth, EPS growth, etc., and we would buy much more heavily if the stock price for ASML crashed down to about 729. And finally, the best, highest scoring company, Meta, coming in at 6.5. This is the only of the 3 companies that we see any positive margin of safety. They're currently trading for 672. Intrinsically, we think that they're worth 712. And so that gives us a 5.5% roughly margin of safety. So if we wanted that cushion and that margin of safety, we would certainly consider buying Meta at 605 or under, and we would buy very heavily if we wanted a nice cushion, a nice margin of safety at 463 or lower. So just as a reminder, nothing that we say on this channel is financial advice. We are not financial advisors. We are not telling you to buy, hold, or sell anything in your portfolio. We are just presenting this information for educational and informational purposes only. But again, if you get anything out of this video, please like and subscribe. Share with your friends and family. Tell everybody about the Interflame Finance methodology. There will be updates coming up regarding how our picks for 2026 are doing so far and how we think they're going to do in the remaining 11 months of this year. So thanks for watching. We appreciate you being here. Check back for more videos on valuations and scoring of the best, most important stocks in the stock market. We'll see you in the next video.